13-year-old real estate investment management company. We have approximately $500 million worth of assets under ownership management, and we really focus on certain types of properties in certain areas. So we're across North America, but on a more macro or micro level, I should say, we're really in very specific markets, and that's the Midwest and the Southeast U.S., in certain markets there, as well as across Canada. Assets we focus on are really office buildings, medical office buildings, and grocer-anchored retail buildings. And there's a lot of reason of why we think those very particular asset classes make sense on their own, as well as when developing a balanced fund, which we'll get into shortly. But a little bit more about ICM Realty Group. We're value-oriented guys, and so we are, I think what's most important is value creators. We like to look for areas, there are opportunities in the market that for some reason have been overlooked by others or have somehow been suffering from the current ownership, and for some reason we think we can do a better job, and we try to take advantage of that. So we operate where we have a competitive advantage. The other thing that's important is we're a real estate company, and we always have been. And what I mean by that is if you look at the experience of the ownership, which is over 100 years of experience at the executive level and over $9 billion or $7 billion worth of transactions that we've done through our careers, we're all real estate guys. We're operators. We're not in real estate because we think it's a newly interesting asset class to be in. We've been in real estate since the beginning. I'm not smart enough to do anything else if real estate doesn't work out. So hopefully we won't go too far off the rails.
You're not trying to dabble in both stocks, bonds, and real estate.
No, we're real estate operators, and a lot of the value that we see is the approach, not just how we buy it, but the approach how we run real estate. You look at Bruce Timm, our CEO, who's got over 25 years. My partner in the U.S., Spencer Patton's got over 20 years of real estate. I've got over 15 years. John Levitt, our Director of Asset Management, over 25 years. Just in the U.S. alone, we've got nearly 100 years of experience just with 3 individuals. And then rounding out the executive set, John Cortliff with over 10 years and Spencer Coupland with over 15 years. So a lot of experience. And what's interesting when you think about real estate companies is a lot of us, or in fact all of us, have had institutional real estate experience in our backgrounds, large pension funds or banks or insurance companies. And what we've all sort of independently realized is that a lot of the things the institutions do is good and a lot of it's bad. But one thing that is good is when you attach an institutional approach to commercial real estate, you deliver a whole new level of service that a lot of tenants aren't used to. And our approach is to have a institutional approach in a boutique setting, meaning that we're 22 people in the organization with $500 million worth of real estate. And so an executive, a principal, is always touching everything. I answer phone calls from tenants directly. I have conversations about the length of grass that I think makes the most sense given a particular region of the country that a building's in that we should have. And the next conversation is about a complicated debt structuring. We do everything from soup to nuts at our team level, and there's always an executive handy. And so when you put decision makers and principals with skin in the game directly involved in every individual asset, you end up with a completely different level of decision making, I think. And you don't get that with a lot of large institutions.
No, I can attest to that. I think that's fantastic, and it really speaks to the importance of the leadership team. Geoff, before, by the way, Andrew, thank you for that. I'm going to take a step backwards here, Geoff, and just before, because that tells us a little bit of who ICM and who the management team is. I think one of the things before we go in and talking about what you guys actually do, or if talking about ICM 9 in particular, Geoff, I do think we need to address a disclaimer. One of the things whenever we talk about investments or anything that has to do with the potential for investing, anybody on the line, it's very important to emphasize that we want to have this disclaimer for legal purposes, and that is the fact that this is not intended as a sales call. We're not trying to solicit directly your investment per se, and you know, I think here's the disclaimer there. A lot of these things are forward-looking statements within the meaning of that phrase under applicable Canadian securities laws, etc. So please understand that if there is anything that attracts your attention that we're talking about here, this is for education purposes only. And if you have any interest in this following this phone call, please contact me directly so that we can do a proper due diligence and know your client process. Geoff, anything else you wanted to add to that?
No, that's great. Thank you, Peter.
Okay, thanks. Always important to get the disclaimer out of the way early. So on that note, Andrew, you're talking about the management team, and the one thing when I look at any investment, probably the single biggest thing that I always analyze and investigate is not the product but the people. You talked about the experience that the management team brings to the table, which is amazing, but what I found amazing when I was doing my own due diligence on ICM and your company was the track record. Perhaps you can speak to that a little bit.
Absolutely. As I mentioned before, just at the executive level, over $7 billion of real estate acquisitions management done. We bought and sold a number of properties, but the total number of properties that we have sold out of is 22. And out of that 22 project, we have over a 15% levered IRR returns that have actually been realized by investors. It's a great return profile for almost anyone. What's more interesting is that we got our start originally in 2003 with German institutional investors. And the investments that we have with those group of individuals and institutions is long-term ownership. They're meant to be stable, not a lot of value creation, own a building for 30 years and let it cash flow. So to get to a mid-teens plus return with a bulk of the portfolio in a non-value oriented piece of real estate is actually quite impressive. We currently have about $500 million of assets under management. And you know what I think is most impressive that, to be honest with you, no one would have thought about before 2008. But since then, this is a really important thing. 0 buildings lost to foreclosure and 0 buildings sold for investor losses. I like to think of it as, you know, we know where to go to find deals. We know where to go to raise money. I have no idea where to go to find another reputation. And that's the one thing that we care more about is protecting our reputation, which in turn just leads to being able to perform for our investors.
That's huge. I mean, because you're not talking about just, you know, you guys got lucky in a few good years and you were able to show a 15% plus return on 1 or 2 buildings. You've actually got a track record over an extended period of time, and you glossed over something that's interesting. And I know we don't want to go into the weeds here and the entire back history, but the president and CEO, Bruce Timm, he has quite a background in working with the German investors that you mentioned, if I understand correctly. And what was interesting, I remember you mentioned that he had like 2nd and 3rd generation investors who are still working with him today.
You're exactly right. Bruce got his start by leaving Canada and going to Germany 20, 30 years ago. And when he did that, he worked for a bank that is the oldest banking institution in Germany. And he was managing real estate investments on behalf of institutional clients. And when he went from that bank to the predecessor of ICM, TMW, he took a lot of those investors with him. While at TMW, created a fund series based on German ultra-high net worth individuals and institutions. And in 2003, Prudential bought TMW, and a number of those investors didn't want to have their money with Prudential. They wanted a shop more like ICM is geared to be, and made the decision to leave the Prudential structure and come start ICM with us. And that bulk of investors, if you will, that high net worth family members are now on the 2nd and in some cases 3rd generation of investors. So we've been managing their money since well before ICM ever started. And the Germans think in terms of decades, not years. So we just renewed our contract to manage the real estate on behalf of them for another 10 years. which says something because Germans are, I love them and I'm in Germany a lot. They're not the most fluid people when it comes to decision making. They're pretty stringent, and so when they put their commitment to you for 20, 30, 40 years at a time, it means something.
Well, I think it speaks volumes because, in my opinion, that's one of the things that struck me, aside from the zero buildings lost to foreclosure and zero investor losses, the fact that you got second and third generations of families who are sitting there saying, you know, these guys have, we've done well by them and we trust them. They clearly do their due diligence and put their money where their faith is. So you guys are doing something right, that's for sure.
Yeah, we think so. We've certainly, you know, as I said before, this is the one thing we do, and we like to think we do it well.
So let's touch base a little bit on the asset class itself, because you know we're looking at commercial real estate in general terms, and I started out by saying, for those of you who missed it. By the way, I did push the record button late, by the way. I said I wasn't going to do, but for those of you who missed it, I started by saying that you know, as an investor in general terms, you're going to have a variety of different asset classes you invest in, and that could be stocks and bonds, private equity, direct ownership of real estate. A lot of people on the call have direct ownership in real estate, but predominantly in Canada. You guys are predominantly U.S. based, and within the real estate asset class, it's commercial real estate asset class. So talk to me a little bit about why, what the appeal is, and why ICM is attracted to commercial real estate as opposed to per se, you know, multifamily.
Absolutely, and let me take it even one step further, if I can, when we say commercial. It's not just commercial, but it's also very specific commercial. It's office buildings, medical office, and grocer-anchored retail.
Mm-hmm.
Let me start with, there's reason behind all three of them. The retail side, it's not really a secret, the internet has changed the way retailers do business.
Absolutely.
It's reduced brick and mortar. It's changed the way the sales tax environment works. It's changed the way shopping and delivery happens. It is a complete change of that process. The one thing that has not necessarily changed with e-commerce is food. It's groceries. A number of companies have tried to do delivery, and some have some small success, but really not on a broad scale. And so by focusing on retail that has a grocery anchor, we have found that outperforms all other types of retail real estate in most markets. And so we focus specifically on that type of real estate for retail. The other thing that's happening is if you look at the demographic profile of the U.S., it's a barbell weighted towards millennials on the younger age and baby boomers on the older age. And the millennials now account for about 25% of the workforce, expected to grow to over 30% within the next 5 years. The others, and they are now the #1 largest demographic in the U.S. The second largest is the baby boomers, which are entering the phase where they need more medical care than before. So we are focused on two things as it relates to that particular demographic. Medical office, and again, just like grocery stores, you can look something up on WebMD, but you're not really going for a spleen operation to do it yourself online. You have to go to your doctor. And the other thing that's happening in the medical world is with the Medical Affordable Care Act that happened in the U.S., it's created an interesting consolidation across the entire medical field in the U.S. so that now doctors and the way hospitals work, they're changing their footprint. Instead of everyone coming to the hospital, hospitals have created more of a hub and spoke profile from a geographic perspective where they want to go out into the communities and they want to have more local, regional, smaller care centers that they can go to. So we can now get into more medical tenancy, if you will, in smaller projects. And so that demographic's not going anywhere. And then on the office side, millennials. You know, the key there is there's a lot of office buildings out there. And understanding what the millennial wants, which makes up as I said, 25% of the workforce, companies have to attract them to survive. And so we focus on those particular office buildings that we believe are best positioned to be renovated into the type of environment that a millennial would want to work for, which attracts the company that needs to hire the millennial. And so by focusing very specifically in markets that we think all the demographic profiles match to outperform the national average with those particular asset classes, and then we focus very granularly in submarkets for those. So that's the focus that we have, and that's why we like that type of real estate.
Well, and it's, again, you hit on a lot of really important points there. One of the big things here is if you're an investor in general, first of all, you, again, if you decide that you want to allocate certain assets to real estate as a class, investment class, and then you decide, well, I've got Canadian real estate that's maybe hands-on, accessing American real estate on, if you're going to buy a rental property in Phoenix or Palm Springs, that's one thing. But commercial real estate is something that a lot of people are really interested in, and there's an appeal to it. But, of course, it's very prohibitive to get into it, mostly because of price points, just the down payment alone. And then if you factor in trying to pick the right markets to enter into, it could be extremely difficult. So correct me if I'm wrong, but that would be one of the big assets or benefits of partnering, not partnering, but investing in a company like ICM, because you're taking a lot of that risk, so to speak, and mitigating it by virtue of your track record, your history, and your peer size. So maybe you can speak to
you're 100.
Yeah,
sorry, you're 100% right on that. And there's another important thing, which is the relationships we develop and the market knowledge that comes with it. We have 4 offices in the U.S. We have boots on the ground. We pick specifically the Midwest U.S. and the Southeast U.S. to invest in. And the reason we do that is because the Midwest outside of Chicago is relatively stable. The Southeast is much more volatile. And if you understand those markets at a micro level, and if you can manage the timing to take advantage of the volatility, and you backstop that with the stability of the Midwest, you have an opportunity to develop a very attractively balanced fund. And it's all about risk mitigation. We are investing money for the purpose of not losing it. And if we can let, and that's job one. And if we can protect the downside and let the upside take care of itself, that's the key. And we do that in a lot of ways, but one of the ways is through geographic diversification. And we like the way, for example, Minneapolis has a tech sector focus and a healthcare focus compared with Fort Lauderdale, which has a marketing focus. And we like those combinations. We like to manage an entire portfolio so that we don't have any overexposure to any single asset class. Or investor, tenant.
Geographic.
Exactly. And
so not just geography, also industry.
That's exactly right. And so the other thing that happens with that is the relationships and the market knowledge. So we have offices in Minneapolis. We have offices in Atlanta. We have offices in Florida. We have offices in California. And we have relationships. I spent 1.5 years in Florida before we ever bought our first building, making sure that we knew what we were doing and we had the right relationships. And we have bought buildings before on behalf of our investors that were competitively bid. There's multiple groups in the final round of bidding, including us, and we have not been the high bidder, and we've got the deal. And it's because our relationships, but also our reputation in the marketplace for knowing what we're doing what we say we're going to do, and being able to execute. And so it's just having that type of market knowledge. And of course, if you live in a city and you know a lot of people in a city and you're smart about a city, you can invest smartly in a city. But you're still relatively subject to the market swings of that particular city. When you invest in a fund or with a company that has a multi-geographic regional approach, you get the benefit of more diversification in more ways across a bigger platform.
I totally get that. That makes a lot of sense. Let's touch on, you mentioned it's a fund. Let's just take a step back here, Andrew, and maybe talk a little bit about what people would be investing in. If you were to invest in ICM, you're actually investing in, well, ICM 9 in particular is a real estate investment trust. Is that correct?
That's 100% correct. And an important thing that you just said is the name of the fund itself, ICM 9. We've done this 8 other times successfully. We're not brand new.
And we'll circle back and touch on those, by the way. But we'll just touch on. I like people to have an understanding what they're listening to and why they might be listening to. What is the at a macro level? What's the opportunity?
Absolutely, great question. Geoff can give a fantastic description of our ICM 9 Real Estate Trust Fund.
Great. So certainly ICM 9, as Andrew's pointed out, this is our 9th fund. Obviously a lot of the previous funds came from German institutional investors, high net worth investors. So ICM 9 is an opportunity for investors through either registered funds, RSPs, TFSAs, LIRAs, RIFs, of course cash, or also corporate or US dollars, a number of different options to invest in a cash flow producing investment, again, a diversified portfolio of commercial real estate, predominantly with a US commercial focus. I think it's important to point out that this is a tax advantaged income opportunity as well as a capital growth opportunity. So for those folks on the call or the webinar that understand return of capital, out of the gate, investors are targeted to earn a 5% per annum return of capital return, which again, if you're comparing that to an interest income payment, may look more like 8, 9, 10%. So again, a very tax efficient quarterly distribution. That will look to increase to about 5.5 to 6% after June 30th of next year. One of the key pieces is when does management participate in profit, and where is their motivation to not only preserve capital but to outperform? So one of the key elements of this structure is a preferred return where before management, before the executive is participating in any percentage of profit, investors need to see their full capital return to them, as well as an 8% per annum return, again, before the profit sharing comes into place. So very
Geoff, I want to, sorry, I have to pause you there, because what you just said, you and I are in this industry, we kind of blow past comments like that all the time, but for the average investor, they may have missed it. I think that's important to really emphasize, because first of all, what you're saying is that 8% targeted return the investor has to get that before ICM participates in any profit?
That's correct.
Okay, so then once the investor's got a return, and for those of you listening, think about that for a second. That means the motivation for these guys is that they have to make sure that you as an investor get 8% return before they get any benefit from this investment. So there are a lot of investments out there. Sorry, I just have to really emphasize, because there's a lot of investments out there where people make a lift on the purchase and they've made the profit before they even make it available to the investor. And so then if they make a profit or they don't, or if you make your return or not, they've already made their money. Geoff, if I'm hearing you correctly, that's not the case with you guys.
Yeah, and I think it's really talking about investor alignment, and we talked about just track record, and Andrew talked about reputation. I think the one thing that is very critical to understand is that ICM and its team wake up every single day defending that track record. And with respect to the deal flow and assessing deal flow and underwriting, we look at an awful lot of different pieces of real estate to potentially be interested in. However, we need to underwrite and do so conservatively to not only preserve capital, but also each of the underwriting models need to be able to generate, obviously at a bare minimum, a situation that would return profit to both investors and to management as well. So Andrew can talk about just the underwriting process, but again, very important to see the alignment in that investors need to see their capital back plus a minimum of an 8% preferred return before there is any share of profit. And again, that profit is shown on screen. Over and above that 8% per year preferred return, the profit is split 60-40, 60% to investors, up until the general partner has earned 20% of total profits, and then anything above that is then 70-30, 70% to investors. So certainly the executive and the management team is absolutely focused on investing very intelligently and in assets that have a business model and a reasonable case to obviously achieve profit, or else it would be a charity, and I can assure you it's not charity.
Well, I don't think you guys have survived this long with acting as a charity. But another important point here is when you have the targeted, and we really, really emphasize these targeted returns, not promises, but if you're targeting a 5 to 8% return, that is considered return of capital, that component of it. Now, it's important for everybody on the line to understand when you're developing a portfolio, and you might have some money in the markets with a financial planner, you might have direct ownership of real estate, and you might sit there with your RSPs and say, we're going to take a percentage of this and move it into private equity, which ICM would be considered private equity. There's a difference between yield products, like, for example, if you invest into a mortgage investment corp and you're getting an 8% yield, that's taxed directly as income. This is different because it's not a yield product, it's actually considered return of capital. Just touch on that briefly, Geoff, why that's important and why that's considered tax efficient.
Sure. So we can depreciate the assets on a schedule that, again, the yield that's being earned quarterly is essentially deemed as return of capital from a tax perspective. I think one.
And that means it's not taxed.
Yeah, it's tax deferred. So the income that's being earned in the first, number of years is, again, return of capital. The only exception to that would be if we did buy, fix, and ultimately sell real estate in the next few years. That obviously would be a capital gains and a possible income trigger. But early on, as we're out raising capital, deploying capital, acquiring assets, certainly the yield being earned at that point would be predominantly return of capital.
Yeah, no, and that's fantastic, and so important to understand that from a tax efficiency perspective. Okay, so let's talk about, I think that gives everybody on the line a really good understanding of what the investment is. You're investing in an asset class that is commercial, predominantly U.S.-based real estate. You've got an opportunity from a 5% to 8% yield on that's tax preferable, if you will, tax efficient, and then growth, which is also tax efficient. So based on the return of capital, I think that gives us a really good understanding of what the investment opportunity is. Andrew, maybe we can talk a little bit about the history of some of the past funds and the performance, and in particular, one of the areas that comes up often is, well, how have you performed in certain years? I mean, was some of your purchases simply, was that something that you purchased in years that had huge growth, or how did you guys do in 2008? Maybe you can touch on some of the past performance.
Yeah, absolutely. It's a great question. And, what you'll see if you look at the series of funds, 6, 7, 9, they have been adjusted because of what we're seeing in the marketplace, what we think is going to happen in the marketplace and what is actually happening in the marketplace. And so, for example, Fund 6, which is also a similar Canadian trust, it started, but it only had a focus in the Southeast U.S. And when we realized that there was an opportunity to balance the fund better by incorporating the Midwest, we stopped Fund 6. We started Fund 7, which grabbed the Midwest as well from a portfolio diversification perspective, as we've talked about. What we realized, because of where we are in the market cycle, I mean, the U.S. has had 7 years of expansion mode. And while future expansion has very little to do with past growth, we do believe that a 7-year growth cycle is a little bit long in the tooth to continue. And so we stopped Fund 7 and we started Fund 9, which will take advantage of the markets a little bit differently by not being forced to buy as much risk, meaning we won't be buying as much vacant buildings as we did because we don't think the market's there anymore. So when we look at what we've done in the past, it's really moving to where we see the markets going. And you look at some of the notable past transactions by management. I mean, we've been involved in billion-dollar transactions before. We've been involved in the Chrysler building sale of $800 million and 666 Fifth Avenue for almost $2 billion. I mean, in the
those are some pretty big acquisitions.
Pretty big deal. I mean, you know, in the early and mid 2000s, that's where the opportunity was, and so that's where we wanted to be. Where we see the opportunity in the U.S. right now is different. We see the opportunity in the U.S. in projects that are sized between around $7 million to about $30 million, and the reason that is because there's so much money trying to get into the U.S. Real estate market.
Mm-hmm.
Institutions have more money than they can put out, and what that leads to is a lot of institutions just doing deals because it means they can write a check and get the money out the door. It's not necessarily the best deal, and so they very rarely want to buy a value-add project that needs some hands-on ownership if it's less than $30 or $40 million. And likewise, the local guys have a hard time writing checks consistently for buildings that are over $7 or $10 million.
So it's kind of a sweet spot in the middle there.
You're 100% right. And as I said before, you know, our focus is to try to play in the world where we have a competitive advantage. And that's one of the ways we do it. And so we think that the opportunity today is in that size range for groups like us. And so that's why we focus there. And so when we look at some of the track record, it's all been, you know, timing right. And a lot of people would, you know, I think could say, well, you got lucky because you bought it here and you sold it here, and that's just the markets. Luck is always a part of everything, but, you know, no, it's not. We put ourselves in position very specifically by going to where we saw the market going. And so a great example of that is to give you one case study. Fund 6 bought a retail project in West Palm Beach called Gulfstream Plaza. And we found this project because we had a relationship with a couple of tenants who we knew wanted to be in this particular area, and we were looking for real estate for them. It's not just always about finding the deal or the building to buy. A lot of times it's about understanding what the need is. And so we manage relationships with tenants, relationships with vendors, relationships with owners, sellers. I mean, we do a lot of off-market projects, and it's because we manage these relationships. And so looking in this market, we found this half-empty building. It is in West Palm Beach. It is on the #1 corridor going east to west through downtown West Palm Beach. This fantastic corner had this half-empty building, 80,000 square foot neighborhood strip center, had a vacant Babies R Us taking 40,000 feet, so half the building. The only reason that that was empty was because of an absentee owner, and that's what we look for. We look for distress. And I like to say we prefer ownership distress to real estate distress because it's cheaper to fix.
That's a very big difference. You know, a lot of people don't understand that simple concept because you think of there's an old saying, the most money you make is the day you buy it, if you got a deal, so to speak.
Yeah, exactly.
You know,
and that's true of this one. We looked for, you know, we saw this distress. We saw the only reason this fantastic location would be this vacant is because the owner's not paying attention. That's exactly what it was. Not a bad owner. They're just too big to care. Kinch,
you know,
one of the largest REITs. Yeah.
Yeah, sorry, Andrew. I think that's a really interesting concept there because one of the values, and you know, for the benefit of everybody on the call, Andrew and Geoff and I were talking earlier, and one of the things that came out is that the skill set that ICM brings to the table is really in your ability to identify opportunities, because at the end of the day, the money's made two ways. Number one, you buy an asset that creates revenue from cash flow, and that's how you can produce the yield or return of capital. But then the second thing is repositioning that asset and selling it down the road, and that's where the profit can come into play. So
you're
skill
exactly
set here is
right.
identifying both.
Yeah, and not only identifying, but creating it as well. And this is a perfect example of that, what we're talking, because this building was half empty. No one was paying attention. Well, we had relationships with the tenant. So we put this building, it took almost 9 months to talk them into selling it to us. We put this building under contract for the price of a 42% occupied building. We brought it, before we closed, we had 2 leases signed with Gordon Food Services and Goodwill, each taking half of that vacant 40,000 square foot space for 10 years. The leases were contingent only on us taking title to the property. So the minute we closed, we had a 92% occupied building. We renovated the building, we put a new roof on it, we brought our tenants into it, and we sold it. And we did it pretty quickly. And you know, we sold it for substantially more than what we bought it for. It wasn't a deal. It wasn't on the market. We created the value because we knew what was happening and we had the relationships.
And you know, a lot of people would miss the fact that one of the biggest opportunities lies in absentee ownership, and that could be a single individual who's out-of-state owner and maybe has developed what they call deal fatigue, or maybe they're just someone that bought it many years ago and is getting older and next generation doesn't want it. Or the opposite of that is a large REIT that's just accumulating assets, because REITs are like bicycles. They got to keep moving or they fall down, and they get, sometimes I've seen a lot of REITs who are doing what I would refer to as irrational purchasing, and they don't do a lot of due diligence. Well, I don't know, I shouldn't say they don't do due diligence, but they can certainly be absentee owners, and that creates opportunities for people like yourself.
You're exactly right, and this is exactly that. It was a group named Kimco, which is a fantastic owner, and they're one of the largest REITs in the U.S. out of New York. And when they bought this particular building 20 years ago, it was a big deal. Well, 20 years later, they didn't care about it. And why would you? They had a $350 million asset across the street they were trying to get ready for sale, and they have billions of dollars in their REIT. Why would you care about this $10 million?
This is just too small. But so it emphasizes the fact that you guys can find niche opportunities that fit your wheelhouse. So just moving along here, I think it's important to emphasize 2 things. First of all, for everybody on the call, if you're not aware of how commercial real estate works, your valuation is always based on your lease agreements, dollars per square foot that people pay you. So if you have a half-empty building, the appraised value could be really low. All you have to do is fill the building and increase the dollars per square foot, and boom, you've just increased the value significantly. And there's another component to this that I want to steer to here, Andrew, is a lot of people, we've spent a lot of time talking about the expertise in acquiring buildings. Well, that's only half the conversation, because where the profit is really made is twofold. Number one, you're acquiring and you're getting value at the acquisition phase, but then there's the selling of it. You have to know how to unload these properties. You have to know to sell it. So correct me if I'm wrong, but a huge market to sell into is pension funds and insurance companies looking and starving for yield. Is that correct?
You're 100% right, and in both cases. Who you can sell it to is a pretty important thing. We've looked, you know, every building has its own individual asset plan. Every building that we look at has to be broken in some way, and we have to realistically believe that we can fix it. If it's been a great owner that has a great leasing and management team and it's still not occupied and we can't identify why, we're not fooling ourselves into thinking we're so great that we have the magic bullet. We have to realistically understand why is it broken and how can we fix it. And just as importantly is, well, once we do that, who are we going to sell it to? Is there anyone to buy this thing, and how big is that buyer pool? And who is the likely buyer? What do we think will happen to them in the time that it's going to take us to fix it that could impact their decision-making process to buy it? And what time of year do they buy it, for example, and what do they need to buy it? And it's not just should we buy it because we think we can sell it to this, but it all along the process is you make decisions based on who that buyer is. So you got to know that you can sell it, and you got to know who that buyer realistically is. And you're 100% right in that. I mean, we passed on deals that are probably great deals, but we couldn't really identify with a lot of certainty who the buyer could be in 4 years from now, 6 years from now, and so we don't want to take the risk. No single deal is worth risking it. And because of the requirement that a lot of institutions have, pension companies, insurance companies, they've got to have yield. and they're searching
starving for it.
Different places. They're starving, and they're searching in a lot of different places, and we love selling to them because, honestly, from their perspective, the difference in paying a 6% cap rate or a 5 3/4 cap rate when it means that their yield is 8% down to a 7 3/4%, they don't care. If it's over 6, they're excited. And so we really try to take advantage of that, and we specifically buy buildings that we know we can sell to the people who are paying the most.
So you already have your exit strategy in place before point of purchase.
We have our exit strategy, our operating strategy, our leasing strategy in place before we ever put the offer in to buy the building to begin with.
Yeah, that's fantastic. You know, again, I like to create the analogy. It's a very close analogy because a lot of the listeners on the line will be residential, primarily residential real estate investors, and one of the common ways of making money in the real estate side is buy, fix, and flip. And if you could imagine someone who had an expertise at identifying rundown properties in really good neighborhoods and having the skill set and the expertise to go in, renovate, fix that up, and bring it up to par with other houses in that neighborhood, you might be able to pick up those low-quality houses or houses that are in need for repair at a bargain relative to other places in the neighborhood, and then with a reasonable cost, bring it up to speed and make a good profit. That's how some people would approach it on a residential side. Really, you guys are taking that to the whole new level on the commercial side.
Absolutely. You're 100% right.
Now, having said all that, and by the way, just a quick housekeeping note, if anybody has a question, there is a question box on the GoToWebinar. You can just click on the question box there and type in your question. So if anybody has a question to ask Geoff or Andrew or myself, feel free to just type that in there. Happy to make sure your questions get answered in this call. So I think we have a really good understanding of who ICM is, a little bit about the background, the strategy, why you're so good at what you do, your ability to identify opportunities and know how to sell it, which is critical, thereby making profit both on revenue and on the eventual sale. One of the things that might be confusing for everybody on the call here is we're talking about ICM 6, ICM 7, ICM 9. What's with the numbers? I mean, what's that all about? What are the different funds? And can you just touch on that briefly, why there are different funds?
Sure. Well, the numbering system is, I wish it was a more creative story, but we really are just trying to not outsmart ourselves. So we just logically follow in the order of fund to fund. And really, we change funds to be proactive and sometimes reactive to the market demands. As I was mentioning, Fund 6 is being raised in Canada, similar to this one, and it was a fund focused on the Southeast. And then we realized that the Midwest offered a lot of portfolio balancing, and so we stopped 6 and started 7 to pick up the Midwest. And
okay, so when you change the direction of a fund, you start a new fund. Is that what it is?
Right, because we have a fund mandate which we would outline to say this is what the fund is doing. And when a fund says we're only buying in the southeastern states of the United States and we see an opportunity to put the Midwest into it, that's the time to stop and to bring in a new fund. And it's interesting because a lot of different groups would try to play in the gray areas of the world, where is St. Louis Midwest or Southeast, or is North Carolina Mid-Atlantic or Southeast, and they stretch the limits of the fund mandate as a way to avoid stopping the equity raise in a way to avoid having to pay more money to start a new fund. We don't do that. We're not interested in operating in a world that is hard to understand. We stop raising, we start a new fund, and we're pretty clear about what we're doing. And so we have turned the funds, if you will, because of where we want them to perform to take advantage of the markets. One fund that we're not talking about, we jump over, is Fund 8. Fund 8 was raised differently. It was a single asset-based fund with a single investor, also Canadian, that just wanted to buy this property. And so we did one project with them, which is sort of why we jumped from 7 to 9. But other than that, they follow the mentality of how are the markets adjusting and moving, and how do we participate.
Now, as a fund gets subscribed, as we call it, and you now can shut down or you no longer attract capital to that fund, you're considered full, then you move on to another fund. We're now at ICM 9. 9 is the fund that is currently available to investors, correct?
Exactly right.
So let's talk a little bit about that then. If we can jump ahead and look at ICM 9. Tell me, I think it's important because effectively this is what people would have available to if they wanted to invest. This is what they'd be investing in. Tell me, what is the specific focus of ICM 9, and share with me a little bit about it.
Absolutely. So the Fund 9 wants to take advantage, as we've been talking about, the balancing of the markets between the Midwest and the Southeast. The interesting part about what we're seeing in the U.S. is we don't think it's the right time in the U.S. to buy as much vacancy, meaning we don't want to take as much risk. We believe there's still growth, albeit not quite as aggressively as there has been over the last 7 years. But we think real estate in the U.S. is a great asset class. It's a stable economy. It's a stable government. It's a stable currency. And you're not really building nearly as much real estate as what exists now. So we are focused on buying good quality, well-located real estate in selected markets that have some opportunity to create upside value. A perfect example of that is the building we just bought for this fund, and we closed on it a few weeks ago. It's in Charlotte, North Carolina, one of the great markets in the Southeast that's sort of a secondary market. And it's a building that is in the best submarket inside of Charlotte. Highest office rents, just outside downtown, but the highest office rents, highest price retail, highest price homes, great little market, and very, very high barriers to entry, which is what we love.
Now, what do you mean high barriers to entry? What do you mean by that?
It's very hard to buy vacant land and build new real estate. You're not building a lot of new office buildings. And so this building, I grew up in Charlotte, and I was a broker when I first started over 15 years ago, and I remember cold calling on this building, and I stopped doing it because I could never get any clients out of this building because no one wanted to leave. There was no work for me in this building. So this building's owned by Deutsche Bank. A group called REEF is the Deutsche Bank Real Estate Investment Group, and REEF owned this. So Deutsche Bank owned building, and they own the one next to this. And this is the perfect example of how to take advantage. The building next to it was twice as big, and Deutsche Bank bought them both in late 2000s, and they made a decision that the other building, called the Rotunda, was going to be the Class A building, and this building was going to be the Class B building. So they put all their money in the other building, and they really didn't pay attention to this one. But the great thing about institutions, they will always spend money to make sure that structure and systems are intact. They just won't spend money to renovate cosmetically and brand and market. So it's a great physical structure. It just still looks like 1988 when it was built, and you can tell that by that giant green marble circle of death entrance that's in front of the building.
That was great in '88.
So as a result, the building's 82% occupied, and the average lease rate in the building is $25.04 a foot. The market is $28 to $29, sometimes $30. Brand new construction, there's one building that's brand new, and it's $35. So we underwrote this building at $27 leasing it up. And so we can take advantage of buying relatively stable building with great tenants. Morgan Stanley, United Healthcare, Zurich Insurance, Coca-Cola, great tenants in this building.
Wow.
Relatively stable, but a very good opportunity to lease up a little bit of vacancy, renovate a building, and really raise rents. So this is the perfect type of project for Fund 9, meaning that we don't have to take a lot of risk to get good returns. We don't have to buy a lot of vacancy.
And again, to emphasize here, Andrew, this is one example. So what's important to understand for anybody, like there are some funds that are set up this way, and they're called blind pools, where there are no assets in the fund. You're just investing in it up front, and then waiting to see what the pool will purchase. This is kind of a hybrid of that, correct? I mean, because you do have some assets that are in there, yet you have assets that you haven't identified that you're going to be purchasing. So maybe touch on that, and also where do we see the fund going? What's the total size that you're expecting to grow this to?
Absolutely, great question. So we've targeted a $100 million fund size of equity. We will use max leverage of 65% per project. So we'd anticipate buying power of $230 million of the total fund. And then in terms of existing real estate, you can see on the slide the first two projects. Number 2 we just talked about, and the reason it says 50% is because it is a JV with Fund 7, which still had some cash left. Number 3 on the list, One Corporate Center, we're closing on that next week. That's an office building in Minneapolis that buying from another institution who acquired this building as part of a very large portfolio purchase. Again, they haven't spent any time on it, so it's 77% occupied. We've already been negotiating with 3 new tenants and expect to be 90% occupied within a year, just based on the tenants we're already talking to. But this is a great Minneapolis suburban building. So then the first deal that we had back on the list was a project we actually already owned in Fund 6, a grocer-anchored shopping center. And so we're seeding the fund with a number of projects that we already had control over. And if you look back at the list that Geoff was just showing, the bulk of what the projects that are on the list from 4 south, those are all projects that we have owned in our German fund series for years. And what's happening is that since we're on the 2nd and 3rd generation of family members in those funds, some of those individuals are looking for a way to cash out their position. Their fathers and grandfathers and grandmothers and mothers made the investment, and now they want to cash out a little bit. And there's not really functionality in the fund to do that. So we created a way for them to do that so that our new Canadian fund could buy into a small ownership sliver. So we will starting...
Which actually includes a couple of Canadian assets as well. I see Calgary, Toronto, Edmonton are in there. But it's important to point, we're talking only percentages of those assets that are in there, correct?
Very correct. A small percentage of the assets individually that we'll be owning in fund out of the gates. And so other than these Canadian assets that we've owned, it will be 100% focused in the U.S.
You know, it's important. I think it's important to clarify for people listening here. On one hand, you might have, if you are listening to that and you say, "Wait a second, Fund 6 sold to Fund 9." Well, that allows people out of Fund 6 to exit. Does that mean people who are investing in Fund 9 were paying a premium to help other people exit?
No, that's a really good question and a very important thing. So what we realized with Fund 9 is that the type of buildings that it wants to buy is exactly this project that we already owned. And we were going to sell it, but then we realized, why would we sell it when we have a fund that wants this type of product? So we went out and got multiple different third-party appraisals to determine value. And that's the value that we're transacting at. But the reason that it's beneficial for both funds, there are a lot of transaction costs associated with buying and selling real estate. There's mortgage tax, there's transfer tax, there's legal bills, there's due diligence costs, there's lender costs. There's a lot of expense, and normally it can be between 3 and 5% of the total purchase price for both parties. So even though we're selling it at a market rate, Fund 6 gets to take advantage of selling at a above market because they don't have to pay a lot of those costs of the transfer.
Right, yeah.
And Fund 9, likewise, gets to buy a building at below market.
They get to buy a performing asset at that market value, which,
exactly.
By the way,
and,
sorry, go ahead.
No, I was going to say, I mean, we're not immune to the ICM, meaning we're not immune to not incurring costs. We're not charging an acquisition fee. We already got paid an acquisition fee when we bought it the first time. We're not charging our own fund an acquisition fee to sell it to ourselves from a different fund. So
it makes a good asset for ICM 9 to bring into the mix and have immediate cash flow so that the people aren't in a blind pool. So that's actually a very unique strategy to eliminate the need, or well, what would otherwise end up being a blind pool. In other words, investing today and then hoping there are assets or waiting to see what might take 1 or 2 years for cash flow to be realized. Andrew and Geoff, I see we're coming up close on the hour. I do have a few questions from people on the line here. So, I mean, gee, if we were talking about this earlier, it wouldn't be, we could easily make this a 2-hour-long conversation because there's so much to talk about. I find the topic, the asset class, fascinating. I think it's just a fantastic complement and supplement to what someone's portfolio may already hold. But let's jump to some specifics about this particular investment. I think it's important to understand, first of all, this is RSP TFSA eligible. We've already mentioned that. When people are making the purchase, they're purchasing units, and those are going to have different purchase prices. I know we've talked about that earlier, that you're going to be changing the pricing on this because you, first of all, ICM 9 has been open for a few months now. Is that correct?
That's right, Peter.
Yeah, and as such, it was originally offered at a certain price when it was more of a blind pool, so to speak. Now that there's some assets in there, the net asset value has increased. So maybe, Geoff, you can touch on that, because the price, depending on at what point you enter and make a purchase, the price changes based on the value of the units.
Sure. Yeah, so as you mentioned, Peter, when the fund launched in the summer, there was a unit price, and that has slowly crept up. So there is definitely a reward for investors who are interested in making an investment prior to the end of this year, and actually with respect to just dates, because it will be closing for the Christmas holidays. Any investor that is interested in investing in ICM 9 and is able to complete a subscription with Peter prior to the 23rd of December is able to invest at a $9.50 unit. In January, that will creep up to $9.75, and then after June 30th, it will be $10 a unit. So definitely a reward for investors who will be taking on a slightly higher perceived risk. But again, at this point within the offering, it's absolutely not a blind pool. We've got a great number of assets that are already in the fund, either outright owned or, as Andrew pointed out, owned 50-50 between both Fund 9 and Fund 7. So definitely a great opportunity for any client that has either cash, corporate, or registered dollars.
So I think you had a slide there that showed the dates and the, there you go.
Yeah. So yeah, certainly if there's some interest, there definitely is a bit of a reward to contact Peter in advance of December 23rd before we close the office for Christmas, and the $9.50 unit will uptick to $9.75. So.
And last but not least, we'd be remiss in not touching on the currency. How does currency play into this? Because at the end of the day, you're buying, you know, you're buying a U.S. asset. One of the questions was, if I'm using Canadian dollars and buying a U.S. asset, how is that tax beneficial? Because I might not be receiving U.S. dollars in return.
Sure. So a couple things there. Obviously, Canadian dollars are being converted down. One of the benefits to having a fund that's open over a period of a year, year and a half, we are dollar cost averaging the Canadian dollars that are being sent down. The rental income obviously being thrown off by the assets and our tenants is obviously in U.S. dollars. So there is a natural hedge, of course, as well, because we are a leveraged buyer. So on the mortgage side that Andrew talked about, obviously there is a bit of a natural hedge there to any foreign exchange. So any concerns overall with respect to foreign exchange? Ultimately, ICM is not a speculator with respect to foreign exchange. We're finding great value assets that we can ultimately fix and improve. Certainly we have the ability to look at a hedging program, but at this point in our previous funds we haven't had to do that as a result of some of the elements, including natural hedging and just dollar cost averaging that we've been able to achieve within our previous funds.
And the important thing here is that the money that's coming back to the investor is in Canadian dollars. It's converted back into Canadian dollars, is that correct?
Depending on the unit class. So we do have a U.S. dollar option, which interestingly enough has been a very popular unit. It seems like a lot of Canadians have maybe sold some U.S. property, maybe holding a U.S. dollar position. So it's been about a 10 to 15% of the units that have been invested today have been in U.S.
So if you have U.S. dollars from the sale of a U.S. or for whatever reason, you can make a direct investment in U.S. dollars.
Absolutely.
Or you can make a Canadian investment in Canadian dollars. And by the way, this is considered a Canadian real estate trust. Is that correct?
Yeah, it's a Canadian purpose in a U.S. REIT, but of course, in terms of how things flow, definitely a Canadian investment.
Right. So if you use Canadian dollars to invest, you're going to get your return in Canadian dollars, so you don't have a tax implication on the U.S. side. Okay, just looking at some of the questions here. And also we can use, we have discovered, we have a trust company here in Canada that actually takes in U.S. dollars in your RSP. So if you have U.S. dollars in your RSP, you can make a direct investment in ICM as well. We found that out this week, which was good news. Okay, I think we've covered off. Andy had a question about the 5% ownership and how do you make management decisions. You maybe touched on that very briefly. There was a lot of companies in the that you've added to the pool already that only have a 5% ownership. So there's a question about management decisions on those properties. Does ICM 9 work in conjunction with, for example, ICM 6 on making management decisions on those properties if they have effectively joint ownership?
Well, to be clear, I guess ICM 6 doesn't exist anymore, and so there is no joint ownership. The only joint ownership project is 6101 Carnegie, which is between Fund 7 and Fund 9, and that's probably the only one that would have joint ownership. Fund 7 actually has a third-party investment committee that has to approve all of the investments. Fund 9 is going to have a similar structure that we've set up, and so it's also, from the investor perspective, I think beneficial to know that there are third-party investment professionals who have to say yes to what we did, and so they will be involved in the decision-making of that particular asset that is co-owned by both. So absolutely right.
Okay, great. And I think there was also, let me just check here, there was another question here. Bear with me. Oh, what's the initial investment, and also if you, and what's the duration that we're looking at here? So is there a minimum amount to get in? Are there any fees that you charge to get in? And what's the time frame that people should look at in terms of an investment in this?
Sure. So with respect to, again, these are targets. These are not guarantees, but the expected time horizon within ICM 9 is 5 to 6 years. With respect to just a minimum investment amount, it's $5,000. And I think one thing that we actually kind of glossed over is with respect to some of our previous funds, in particular ICM 6, that's a fund that we've actually gone full cycle on. So we didn't really touch about it, but again, any investor who would have invested $100,000 in Fund 6 with us when we started, and then carried that through the full investment cycle. The average return for ICM6 investors is 13.3% per year. So again, $100,000 invested in that fund would have grown to just about $140,000, and that would have been very similar to what ICM9 is expecting in terms of a combination of both quarterly distributions that are, again, tax efficient, and then once we actually start to sell assets, then the special distributions and the capital gains would kick into play there. So this is a great example of our last shift on the ice, if you will, where we delivered and exceeded what we said we would with respect to performance, again 13.3%. But one of the key pieces here too is that we were able to achieve our business objectives and business plans for each of the 3 assets that we acquired, and we're able to exit this fund 3 to 4 years ahead of schedule. So again, I think a pretty important and certainly impressive result with respect to a very recent full cycle windup of an offering. So with respect to ICM9, we're targeting in that 5 to 6 year range. Again, there's no guarantees on that, but certainly as Andrew talked about our track record and reputation, obviously if we're going long with respect to our business plans and holding some of these assets, that absolutely will impact our overall performance number, which again is just shy of 17% levered IRR. So we're definitely a group that is very cognizant of time. So.
Fantastic. And the last question there was redemption. If somebody is in this and for whatever reason they had a life event that they needed to get their money out, just touch on that briefly as we're up against the clock here.
Sure. So certainly redeemability within an offering is important. We definitely want investors to be able to invest with us for the full cycle. However, if a life event happened, there are some redemption terms associated with the offering memorandum. This is just a quick example where if you invested in the offering for the first year following your investment, you would be able to make a redemption request, and if the other terms and conditions of the OM were met, you would be able to redeem out at a 10% penalty of the most recent net asset value. In the second to third year, that would go down to 5% penalty of the most recent net asset value, and then any time after that, it would be potentially redeemable at the most recent net asset value.
So yeah, and the emphasis there on the net asset value. So effectively, for the first 3 years, there are going to be some penalties to get out, but if you do need capital, it's not like you're locked in and can't access it. And you know, it's important for everybody to understand that the nature of private equity is that you make this investment into a private company so that they can utilize your funds to grow, and the less they have to worry about redemption, the more they can focus on growth. Gentlemen, we are up against the clock, and I think this has just been fantastic. I want to thank both of you. First of all, before we sign off here, is there anything else that you haven't touched on that you think we missed here in 1 minute or less?
I think it was a great dialogue that we had, and we talked about a lot of things. It's a lot to digest. I would just add that to the extent that any individual is interested in learning more, certainly they would contact you, and we're always happy to have a conversation separately with you and any investor diving into a bit more detail. But I would say that I think that the U.S. real estate market for what we do right now is still in a great position to take advantage of. And I think as anyone looks at their total investment portfolio, alternative asset classes, specifically real estate, is a great place to be. And I think if you have, especially with our audience, a predominant amount of investments in Canada, diversifying country risk away to America is a good place to look as well. So whether you invest enough or not, I'm a big proponent of real estate, and especially of U.S. real estate, and I would encourage everyone with any interest to take the time to look a little further and consider U.S. real estate investments.
Well, I couldn't agree with you more there. I think, as I've said more than once on this call, I believe it's a fantastic complement to what you may or may not already own. There was one last question here. Does Trump's win give you greater confidence in this venture or less? Oh, my God, that's another hour conversation if we bring Donald Trump into the
No, it's so much more confidence because it just shows you that anything is possible in America. We're just ready to do more deals.
There you go. Well, you know what? I really don't want to go down that rabbit hole, but I will say this. It's the one thing I want to be the devil's advocate here. A lot of people might say, well, maybe that run, okay, the market crashed in 2008, it tanked, and if you picked up properties from 2009 through 2013, yeah, anybody could have made money because the market recovered, but that run's over. We've missed that boat. It's too late. Real quick, what's your answer to somebody says it's too late, you've already missed the run?
Yeah, you know, I think that I've got two answers. The first one, and I'll be brief, but back to Trump. In all reality, the U.S. right now has a Republican president, a Republican Congress, and a Republican Senate. And Republicans are very good for the investment climate and for the business community. The stated objective is smaller government, lower taxes, more business-friendly environment. And so from a real estate investment perspective, we're impacted by two things: how companies can grow and where the interest rates are. Interest rates are relatively stable. We're expecting an increase in a couple of weeks at the next Fed meeting, which has already been priced in.
An increase from record lows, by the way.
Exactly. So we actually, you know, Trump or not, a Republican-controlled government, we think we've got 4 years of continued growth now because of it. So that's one piece. On the other piece, you know, a cycle by definition is purely that. It's cyclical. And so as long as you understand where you are in the cycle, where you're going in the cycle, and a relative, you know, industry expert, there's always something to take advantage of. And our history of changing our funds to meet those needs, I think, shows you that we know what's happening in the market. We haven't missed anything. We're just at a different point in the cycle. And a group like ICM that's small enough, that's nimble enough, that's creative enough, and has enough of a skill set to take advantage of that is the type of company one, I think, wants to invest with. So we're excited for where the next 4 or 5 years could be, and I think we're well positioned to take advantage of it.
There you go. Andrew Webb, Geoff LaFleur with ICM. Gentlemen, thank you very much for being on the call here today.
Thank you very much for having us anytime. It was our pleasure. We wish everyone a happy new year and all the success in the world, and hopefully we'll have a chance to continue all our relationships together going forward.
Fantastic. And in wrapping up, as you can see on the screen, my contact information is there. And if any of what we've talked about tonight is of interest to you, and if you'd like to have more extended conversations, please contact me directly. Peter@peterkinch.com is my email address. 604-939-8326 is the phone number. And you know what? Honestly, regardless of what you're investing in, you should start with a plan. So please contact me if you haven't already to do the gap analysis, identify where you are, where you're going, what your plan is together, and then we can talk about how ICM may or may not fit into that business plan. Ladies and gentlemen, that wraps up our webinar for this evening. Again, I want to thank Andrew and Geoff for being on the line with us, and we look forward to talking to you. And if I don't talk to you before, by the way, last thing, I can't forget this, it's December, again, Geoff, remind me, December 23rd is the next price point change?
December 23rd.
So, not trying to pressure, but that's just a reality that the price on ICM changes as of December 23rd. So if you're interested, please contact me, send me an email. And I'll look forward to talking to all of you. In the meantime, have a fantastic night and a wonderful week. Okay, that's all for tonight, and we'll talk to you again on the next webinar. Bye for now.